Welcome to the Value Investment Partners Yearly Review. Here, we'll take a look at the impact of events throughout the year, our economy, as well as the performance and movements of your portfolio. By far the most significant event of the 2016 financial year was the exit of the United Kingdom from the European Union on the 23rd of June, an event otherwise known as Brexit. The result came as a shock victory for the Leave campaigners, who were paying a 4-to-1 chance of winning by major bookkeepers. As the world was largely expecting the Great Britain population to vote for a stay decision, this made for a dark day in all global markets, with $50 billion wiped off the Australian Stock Exchange. Despite VIP's belief that Britain was more than likely to stay, we had organised a contingency plan to cater for both possibilities, and as a result found ourselves with the opportunity to increase our holdings into the market at severely discounted prices. In terms of our own economy, Australia's market has been fairly robust considering we are well past our peak in the mineral capital spending cycle. Strong growth in consumer spending, housing construction and exports have helped offset the downturn in mining investment. The economy grew at 3.1% this year, the highest annual growth reading for 3.5 years, and a figure that was largely aided by a low Australian dollar, which stimulates our economy. Notably, the RBA continues to attempt to push the AUD further down through rate cuts, with the RBA cash rate reduced from 2% to 1.75% in May. Australia's seasonally adjusted unemployment rate unexpectedly fell to 5.7% in March 2016 from 5.8% in February, this being the lowest jobless rate since September 2013. Given it was a turbulent time on the global markets for financial year 2016, VIP has proven resilient throughout this period. The growth portfolio recorded an 8.33% return, more than doubling the index's 4.04%. Furthermore, this return was achieved while taking on less risk with a standard deviation of 9.2%, which was exceeded by the index's 10.3%. There were several changes to the asset allocations of the growth portfolio throughout the year. The financial year began in July 2015 with the growth asset allocation reduced from the target level of 80% to 60% due to concerns over high share prices compared to valuations. In August, this concern still held, although the investment committee saw confidence in property securities and thus increased the growth asset allocation to 70%. In October, the committee began to see opportunity in the market and thus increased its exposure to Australian equities, and in doing so, reduced its USD holding. The growth asset allocation was returned to its 80% target weighting for the first time this financial year in December, after selling out of USD due to the US Federal Reserve's decision to raise interest rates in America. There was no change to the growth portfolio weightings until April 2016, where the Australian equities and property securities weighting was reduced and held in cash due to the belief that the market featured too much volatility at this time to be at target level. Return to near target level was achieved in June through the increased weighting to Australian equities, indicative of the committee's belief that there is opportunity and value in the market as a result of the Brexit decision. Over the year, the VIP Investment Committee largely got the portfolio weightings correct. Both Australian and international equities were overall underweight, a positive as the respective asset classes struggled throughout the year. In contrast, property securities and fixed interest were held overweight and both asset classes exceeded expectations. Unfortunately, cash was held underweight. This concludes our 2016 financial year review.